Good afternoon, and thank you for joining us today for our webinar to go over our latest RCP investment, RCP LI Self-Storage. We really appreciate you spending your time with us today. I'm Blake Lugash. I'm the CEO of RCP, and today with us we have Drew Dolan, the principal and founder of DXD Capital, our partner in this deal, and James Hamilton, the vice president of development, who is in charge of this deal on behalf of DXD. As many of you who invest with RCP know, we are very selective with the investments that we choose to bring out to our investor pool. And what is really important to us are competitive advantages. And we really want the projects that we bring to our investors to be different, better, and more likely to succeed than the next deal that could be down the road or across the street. And so we spend a lot of time on these key competitive advantages. In this case, we were very, very excited when we were brought this deal. It's got incredibly high demand for self-storage in this marketplace. There is a very low supply of self-storage, and it's got significant barriers to entry. There's a very lengthy and burdensome entitlement process, which we always think are great indicators of successful projects. In addition to that, we've got a great partner here with DXD Capital. DXD Capital focuses solely on self-storage development, and they're very data-focused, data-driven. They use a lot of research to make sure that they look at markets across the US that have all the key components that would identify an excellent self-storage site. And then from there, they go and they see where they can go get land, get the entitlements, and make it happen. So they start with data and they work themselves down through a funnel until they end up with excellent sites. To talk about this deal, this is a 664 unit climate-controlled self-storage facility in Huntington, New York. Huntington is an affluent commuter suburb of New York City, fully built out, no additional green space. Anything that is going to be built in Huntington is going to be some sort of redevelopment of an existing use. So again, really high barriers to entry. When we look at self-storage, we look at the primary market area. The primary market area is usually a 3-mile radius for the property. In this particular case, the PMA here is 80,000 residents in the 3-mile PMA. It's about 136,000 average income. And what is really key to this deal is that a stabilized market has about 7 square feet of self-storage supply per capita in that PMA. Here in Huntington, we have 1.9, less than 30% of what is considered to be a stabilized market. Really a superior forces for what should be an ideal opportunity. So after the presentation, we're going to open this up to Q&A. And we want, while you're thinking of your questions, to show you the instructions on the screen. If you click on the chat console on your Zoom console, you can type in questions that will come to us. And at the end of the presentation, we'll try to answer as many of those as we can. And Drew and James and I will be available to address those. So let me introduce Drew Dolan and James Hamilton with DXD, and they're going to talk a little bit more about this project.
Hello, everyone. My name is Drew Dolan. I'm one of the principals here at DXD and one of the founders along with Corey Sylvester. I've been in real estate for 20 years. I've got a very diverse background in terms of development experience with multifamily, senior living, hospitality. I got into storage about 7 years ago and really, frankly, just fell in love with the asset class for a couple of reasons. One, the utilization in the US just keeps increasing. Every year, more and more people keep using self-storage. I love that it's pure real estate. You make money or we make money in self-storage based on our decision where and when to build. And it's so different from other asset classes like senior living or hospitality that are more operating focused. Senior living is all real estate. The real estate's what's important. And building self-storage is frankly simple. What's complicated is that once it's built, there's very little an owner can do to increase value. Going back to my comment about it being all about the location. And self-storage really at its core is just a commodity. There's no brand loyalty in the self-storage industry. Nobody says, I'm going to go store over here because I love their brand. That just doesn't happen. When people use self-storage, they all go through the same decision matrix. How close is it to my home? Is the unit size I want available? And how much is it? And because it's a commodity, you can use data to drive your decisions. That data is much more relevant than it might be for an asset class like multifamily. And DXD, all we do is self-storage. That's our bread and butter, day in and day out. A lot of groups that invest in self-storage say they use data to make investment decisions, and they probably do use some components of data, but they really can't compete with the scale and efficiency and advantages that we have to find opportunities really that have the highest returns for our investors. And some of those data, a lot of that data analysis starts with rental rates. Rental rates are really the primary indicator of how a market's performing. And because those rental rates are dynamic, meaning that of the more sophisticated REIT and larger operators, they change rates every day based on what's going on in that market, how many 10 by 10s they have left, what happened in that week last year. They change rates, and so we can really look at what is going on in a market based on what the demand looks like. Of the 55,000 facilities in the US, 35,000 of those publish their rates online every day. So we scrape those rates and look at those rates over extended periods of time. And so there's some incredible transparency into how a market is performing based on those rates. But the rates only tell you a part of a story. They really tell that story up in the past, as far back as you want to go, up until that very moment you're analyzing. But really what our goal here at DXD is to conclude on how a market is going to perform in the future. And there are other data sets like how many new multifamily and single family homes are coming online? What's the job growth? What are the traffic counts? Where are the customers going to be coming from? And our job is to take all of that data and really to draw conclusions on where we should invest. DXD is developing from Rhode Island, Hawaii. We look at the entire United States to pick those markets, those pockets where we know we're going to overperform based on what our data says. One thing that's unique about us in terms of developing in such a wide range is that we use the REITs as our operator, either public storage or extra space. We simply pay them a fee to essentially rent their brand. But what's really, really important, back to this comment of self-storage as a commodity, it's really important for us to stay focused on what is the rate strategy once we open. And so we're highly focused, directing those REIT operators where to set rates in order to have the best outcome, the best financial outcome for us. In our time at DXD, we built one of the best teams in the self-storage industry. We have 28 people of the hardest working, most entrepreneurial group of people that I've ever worked with all working toward one mission. And that's to leverage tech to create efficiencies and scale that produce superior returns for our investors and our partners. Now I'm going to turn it over and we're going to talk a little bit more about this specific project. One of the reasons I'm excited about Huntington, Long Island, is it's one of the first projects we put under contract. It's taken us about 30 months to get the approvals. And I love that barrier to entry story, because if self-storage had one Achilles heel, which it does, it's oversupply, and markets do get oversupplied. But we can really hedge that oversupply by building in markets that are really hard to develop in, that take a lot of time, that require a variance or a zone change to get something done. And Huntington, Long Island is a perfect case study where somebody else coming behind us will take that much longer. Will take as long as we did, 30 months to get things approved. And that really creates this natural barrier to oversupply. So with that, I'm going to turn it over and we'll get into the specifics of the project.
DXD's Huntington Station project is located at 403 Oakwood Road in Huntington Station, New York, which is in Suffolk County, Long Island, approximately 30 miles east of New York City. Huntington is an affluent community along the North Shore of Long Island, mature market with nearly 80,000 people in a 3-mile radius and 168,000 people in a 5-mile radius. The median household income for this area is over $165,000 in the 3-mile radius and over $170,000 in the 5-mile radius. The property is situated on Oakwood Road at the intersection of Oakwood and Craven Street. And the property sees about 20,000 vehicles per day. In addition to that, it's half a mile north of Jericho Turnpike, which is a major highway that runs east-west from Queens to the east end of Long Island, and that sees just over 29,000 vehicles per day. More local to the market, this is our site right here along Oakwood. It abuts the railroad tracks for the Long Island Railroad with direct service into New York City. 7-Eleven, Ford, Toyota are located immediately adjacent to the site, along with an extra space self-storage facility across the street on Oakwood. To the south is Jericho Turnpike, again east-west out to the east end of the island. In New York Avenue runs north-south into downtown Huntington and Huntington Station, along with Oakwood Road. And then to the south of Jericho is the Huntington Shopping Center, or the Walt Whitman shops with major retailers, national brands. And along Jericho, a handful of other restaurant commercial uses. One thing about Huntington that you don't see in every mature, densely populated market in the Northeast like this is there is some growth, particularly near the Huntington Station LIRR stop. Eagle Rock Apartments, 100 units, and then Avalon Huntington, another 300 units that have been delivered within the last few years right here. So the property itself is a triangular shape up to the railroad tracks. It doesn't include this storage yard right here. This is Oakwood. This is Craven Street, as I mentioned. Single access point along Oakwood with parking along the south. The office predominantly located across the drive aisle, and then the single loading point adjacent to the office with 2 elevators to serve floors 2 and 3, and then also the basement. In an effort to capture as many Long Island Railroad riders as possible, we did a jagged site plan here, which will feature display windows picking up riders as they go west towards the city or back east towards Huntington Station this direction. So the current supply in the market, there are 4 existing facilities right now. This property right here is a U-Haul. It's only about 8,000 square feet. I don't think it's comparable to the product that DXD will be delivering. This facility right here, further east on Jericho, is a Simply self-storage that was delivered in August of 2020. And as of March of this year, that facility has reached 95% occupancy. So they are stabilized at this point. And this is the only new facility to be delivered within the last 20 years in this market. Closer to Huntington Station, we have a storage post. Another Class C facility is developed two decades ago, reporting high occupancies and high achieved rates. And then high asking rates, excuse me. And then directly across the site from DXD site is 380 Oakwood Road, which is managed and owned by Extra Space Self-Storage. I'll talk about that in a minute, but another mature facility that is maintained mid to high 90% occupancy for 3+ years now, and extremely high achieved rates. Square feet per capita in the market, less than 251,000 rentable square feet. Again, just a densely populated, mature market with high barriers to entry that are going to keep too much supply coming online, and is why you've only seen this one facility be built in the last 20 years. So this chart, I think, does a great job representing the achieved rates and compared to DXD's underwritten rates for our development. This line right here, you'll see our DXD's underwritten rates in the model for year 1, 2, and 3. This blue line right here is asking rates in the market for the facility. For the storage post, simply self-storage, and extra space, it's a blend. These projected rates are what Extra Space has provided us, since they will be managing our facility for us. It's what they are projecting we will be able to achieve in years 1, 2, and 3 until we ultimately hit stabilization, which you can see is substantially higher than what DXC is even underwriting. And then this graph, or this line right here, are the achieved rates at the Extra Space storage located on 380 Oakwood. That facility is achieving just over $400 for a ground floor 10 by 10, which is extremely strong for any market, and in this market as well. And you can see just how much higher those achieved rates are, even over their projected rates, and especially over DXD's underwritten rates for the facility. Lastly, I want to talk about new storage supply. I did mention the high barriers to entry. The only new property to be delivered in the last 20 years is the Simply Self Storage located on Jericho. To the north of us, there is another project that has received their zoning approvals. The property would be comparable to DXD's site, located just on the other side of the railroad tracks. It remains to be seen if this facility ends up getting built. They received their zoning board approval in September of 2022. Since that time, there's been no movement on their application, at least that we're aware of. They have not received their site plan approval, and we're unsure if this facility will be delivered, or if it is delivered given where they are at this time, we think they're at least 7 months behind DXD in pursuing our approvals. The entitlement in Huntington is all through the town of Huntington. It's a 3-step process with 3 public hearings. You first go to the planning board to get a recommendation to the zoning board for a conditional use permit, which DXD did. We received our planning recommendation in March of last year. We received our zoning board approval in May of 2022, and we ultimately received our site plan approval in September of 2022. This new project right here, they received their zoning board approval in September of 2022. So if they were on a similar trajectory as DXD, they would have already received site plan approval, which they have not done yet so far. So with that, I will turn it over to Drew Dolan to share a little bit more about the self-storage industry at large.
Now I thought we'd go over some past performance of the self-storage sector. So this chart right here is all the REIT valuations, all indexed back to December of '93 for each of the separate asset classes. So self-storage, every self-storage REIT, every industrial REIT, every apartment REIT. Self-storage REITs are really led by the big 4. You got Public Storage, Extra Space, Life Storage, which is about to sell to Extra Space, and you got CubeSmart. You can see self-storage just by and far has done so much better than all the other REIT assets. One of the reasons it's done so much better is just that the profile of those using storage is younger. And so if you combine millennials and Gen Z, that's over 50%. So of the storage renters today, over 50% of them are millennials or Gen Z. One of the reasons that Gen Z category is so small is they're very young. So that 14% is primarily made up of students at the moment. But as that generation gets older and older, we'll see it start to expand. And it's more than likely that it'll be even larger than the millennial cohort in terms of using it, because such a greater percentage of that generation uses it. So millennials and Z make up more renters than the X and the baby boomers combined. And storage rates have had a really amazing story over the last 10 years, where you look at the blue line, that is Extra Space. That is all 2,000 of their facilities, year over year performance. And so what you can see is that very positive, and then it dips down in December of 20. Actually that's more like March, April of 20, right when the pandemic was happening, was kind of the low point. And the REITs had never been through a pandemic, just like the rest of us. And the REITs only have really one lever to play when they want to drive an outsized portion of lease up, or to capture every customer out there, and that's just to drop rates. And so the REITs really dropped rates right as the pandemic started. But as the lockdowns slowly stopped, you can see what rates did. I mean, just absolutely skyrocketed up until the summer of 2022. And, the reasons behind that are, pretty obvious, but work from home, work out from home, moving bedroom furniture to make room for an office, students moving back in with their parents, parents moving in with their kids. I mean, all that disruption just caused an incredible demand driver for self-storage. And because the dynamic nature of the rates, where all the more sophisticated operators are repricing their rates online every single day based on supply and demand, you can really get a really great indication of how a market's performing because of that reason. And because also the rents are month to month, the leases are month to month for every customer. That's a really incredible way of tracking inflation. So as you see this demand going up, which means all your empty units, you're pricing higher and higher, but you have this base load of existing customers that probably was in at a lower rate. And then because they're a month-to-month lease, you can mark them up really aggressively. And the reality of self-storage is about 80% of the customers pay on a credit card. So if your credit card's anything like mine, I get a charge from Apple, I have no idea what it is. Amazon, no idea. But it's small enough that I just don't dig into it. Same thing with storage. If somebody's paying $100 for their unit a month, and they get a 10% increase, which is a big increase, that's 110. Is that $10 enough money to take a Saturday and go move your stuff out of self-storage? And the reality is, nobody moves out of one self-storage facility into another to save money. It just doesn't happen. You finally get tired of paying for it and you give it away or you sell it. And then the cycle starts over again. But really, the pandemic was this step function of demand increase for the entire industry. And yes, that increase has come down, and you can kind of see that in the rates, what's happened. But really what we're going to start to see in 2023 and beyond is that rates are going to be on a general upward trajectory. It's, I call it 2020 was really the start of the next cycle. And one of the reasons that we believe the rates are going to continue to climb is just that demand will outpace supply. It's a very challenging time to develop real estate right now, with construction costs being high, with loan to cost, loan cost being lower, interest rates being high. There's a lot of headwinds, which means a lot of projects that were scheduled to start in 23 or 24 just aren't going to happen because they don't pencil. And so that's why we believe whatever we build in 23 or 24 is really going to be gold, because it's going to have a lot less competition from other competing projects down the road. And then finally, to wrap it up, I mean, self-storage has this really amazing resilience during recessionary times. And fundamentally, that's because, things happen during recessions, just like they happen during good economic times: divorces, moves for jobs, downsizing. And one might argue those things actually happen more during recessionary times. And so storage does well in good economic times, but it does well in tough economic times too. And you can see this in this graph where you have annual return on the y-axis, and really risk. What's the standard average return deviation on the x-axis? And when you look at these fundamentals, storage just stands out as an asset class with a growing utilization in the US, with really strong fundamentals of why it's going to continue to improve, with our thesis that if you pick really great real estate in markets that have high barriers to entry, meaning it takes effort to get things approved, and Huntington is a great example where it took us 30 months to get that project approved. It's a really long time. So anybody coming behind us is also going to have to spend 30 months, which is a big commitment for anybody from a time and capital perspective. And we know that's going to keep other competitors, at bay, or not as excited about going forward with those really long, really tough projects. And that's why Huntington just has an amazing barrier to entry story, and is going to be successful for a very long time. Thank you so much for joining us. It was really great. We're always open to questions, whether it's an email or a phone call or another Zoom. Don't hesitate to reach out and ask us questions. We love them, and really hope to meet you all soon. Thank you so much.
Well, that was a lot of information. And I think you can see that Drew and James and the entire DXD team really know what they're doing, and they're experts in the self-storage development space. So as we mentioned, we would like to open this up to questions, and Drew and James and myself are available. I think we may have a few questions from the people on the webinar. Tracy Reddy, who's our Executive Director of Capital Markets, is going to MC this for us. And so Tracy, can you tell us any questions we've heard, and we can figure out who should maybe address them, either Drew, James, or me.
Considering this project is in New York, is it union?
Drew or James? James, you want to take that?
Yeah, I can take that, Blake. It's a good question. And no, this project was not bid or awarded based on a union contract. The GC that we've awarded the project to is Park East Construction. They're a Long Island-based general contractor. In fact, their office is located half a mile from the subject site. And that was brought up early on in the bidding process, whether or not we needed to engage unions here. And they did not, and they've built multiple self-storage facilities on Long Island not using union labor. So it's not union.
And it's probably worth pointing out that it also is being built under a guaranteed maximum price contract. And, I don't know if James, you want to go into any more of the details on this, but a significant amount of the could be considered volatile components have already been pre-purchased. So the pricing on that, on the steel components and the HVAC units and some electrical components has already been bought, and that price is fixed now. So that, always a concern when we do development projects, but that's one we've mitigated here.
Yeah, that's exactly right. The volatile components of it really is the material. And in a self-storage facility, primarily with steel, with your structural system, your mechanical units, the actual storage units themselves, there's a lot of steel that goes into that. So Park East has already placed purchase orders, put that material into production so that at the time they mobilize to the site, they'll be ready to take delivery of that material to store it on site, or if they're not ready to take delivery, then we'll store it somewhere off site in a bonded, insured warehouse. But in an effort to
And
get
another
out-
storage facility.
Right, short term though.
I couldn't help myself.
Yeah.
Tracy, any other questions?
Yes. Do I need to pay taxes in New York State?
Yes, New York is an income tax state. RCP has lots of projects in various states. We have successful projects in Colorado. We have had some projects in Oklahoma, in New Mexico. Investors will have an option. They can choose to file taxes on their own, and they will probably have a lower tax rate if they choose to do that. Or RCP will offer an option to participate in a composite tax return, in which case the RCP partnership will fulfill their tax reporting obligation in New York, and they won't have to have any sort of taxing requirement in New York. So it depends on the investor's choice.
What is the FEMA 5-year risk zone for this site for flooding?
James or Drew, do you know that? I'm guessing this is not in the FEMA floodplain.
No flood zone risk here. In fact, we're doing a basement at this particular location. So the water table flood zone is not an issue.
Can you talk a little bit about DXD's track record?
Yeah, this is Drew. We formed in 2020. We've raised about $100 million of capital. Like I said on the video, all we do is self-storage. I've been in commercial real estate for 20 years, been in self-storage specifically for about 7. We went out and really put together the best team. For example, Rod, our head of construction, he's built over 100 self-storage facilities. James Hamilton has been in storage for around 7 years as well. Of our $100 million, we put about 60 million of that to work. We've got 2 projects open, 8 other projects under construction. More than happy to kind of talk about how those are performing, both from a contract perspective and a lease up perspective. But really, even though DXD's young, we've got a group of very, very seasoned individuals running it.
That sounds great.
Could you discuss briefly the financing on the project, construction long-term perm financing?
Yeah, anybody that's active like we are in construction debt at the moment knows the markets are in complete disarray with so many banks pulling back or really only lending to relationships that were existing. Of 50 banks we talked to, probably only 5 of them are actually active. On a macro scale, it's going to be an amazing thing, because for those of us that can get debt and can get deals done, these deals are going to have very, very little competition. And it's why I don't have a whole lot of faith in the project that's near us. It actually gets done. One, I know their equity partners, a lot of them are off the table. And 2, debt is just so challenging. The debt on this is going to be a bank that's based in New Mexico with offices in Texas called Century Bank. They're a 20-year relationship of mine. They financed 8 projects for us already. We know them very well. They're a community bank. They follow us all over the country. It's really a rinse and repeat of past deals. It's 65% loan to cost. The rate is SOFR plus 300. The 36-month interest only period with a 5-year total term on the debt. So, the goal for us and for RCP is, get it stabilized, find the opportunity, exit to one of the large groups that really wants this asset for cash flow.
And as Drew just pointed out, that is our business model. Usually is to invest, to execute, and to then dispose of. And so that this loan really suits us well for it. At 65%, it's just the right amount of leverage, not too much leverage, but it certainly, it doesn't put the deal at any more risk than we would want it to be. So, pretty good debt terms in this environment, and should set this project up for success.
We just have time for a couple more questions regarding the potential competitor across the tracks. do your projections assume that project will or will not be built?
Yeah, our underwriting assumes it is built and it does compete with us. And so the vulnerable time for self-storage is really during the lease up. Once a self-storage facility gets stabilized, even if there's new competing facilities, yes, we will compete on price for new rentals, but all the existing in-place renters, nobody leaves our facility to go to another facility to save $20. It just doesn't work like that in self-storage. And so we really feel like this, given the pent-up demand, given that we know Extra Space across the street from us is 98% occupied. James showed the rental chart of how much higher Extra Space is in their in-place. And so long answer to a short question, which is yes, we've underwritten them as starting. If they don't start or seriously delayed, I think our returns are going to look substantially better.
Tracy, maybe one more question.
Just to be clear, is it the case that no DXD projects have yet sold at the end of its investment period?
Yes, I've sold storage projects. Our team has sold storage projects. We have not sold. We have not exited, partially because that's also not a core of ours. You know, we do like to hold assets longer term. And so for us, especially in our first fund, it is a 7-year time frame. It's what the investors signed up for. We will put mini perm debt on it. So back to the question, no, we haven't, but it's also not our core strategy to sell assets.
And I think another point to bring up, Drew, to add on to that is we have not performed this as a portfolio sale, but there definitely are what are considered to be portfolio premiums that are obtained when you can sell multiple projects at the same time to a single buyer. There's a lot of institutional buyers out there who are trying to place large amounts of capital, and if they can do that, they will have a more aggressive price. And so this project can be, it doesn't have to be, but it can be timed quite well with some of DXD's other projects. And each project will have its own valuation. There's no concern about how you value the project, but as a collective, it could be in a portfolio of assets that then attracts even a slightly lower cap rate, which would yield to a higher purchase price. So that is just something out there that we get by partnering with DXD.
Yeah, that portfolio premium now is 50 to 75 basis points. I mean, pre-COVID, it was 25. It's just gone up and up as the industry consolidates, the big players get bigger. You know, those big buyers are looking for lots of assets. They just have trouble purchasing one off. So they're looking for a pool that they can put a lot of money to work quickly.
Well, Drew and James, thank you so much for your time today. We really appreciate everyone who participated in our webinar. If you send in a question or you have a question and we weren't able to address it, please reach out to us. I think most of you know how to get a hold of us here at RCP. We're pretty bullish on this deal. We are calling for expressions of interest by Monday at noon. And then just to keep on your calendars, we need to fund this deal. We'll ask for your funds by Friday, June 2nd. So that gives you a little bit of time to get the subscription agreement complete and get your funds into us. With that, we will conclude this. This will be available on our data room through our investor portal for future viewing. And if you want to have any of your friends, colleagues, relatives look in this deal as well, we'd love to talk to them and tell them more about this deal. So thank you again for your time today, and take care.